Well, sentiment soured once more last week, with stocks slipping into the weekend as a round of de-risking took hold, which in turn gave treasuries a bit of a helping hand and also pushed gold to fresh record highs too. Although it must be said that the FX market, among all of that tumultuous trade, continues to really meander along and tread water a little bit in relatively familiar ranges. This week, focus will fall squarely on trade and tariff developments as, of course, Liberation Day looms on Wednesday and a whole host of reciprocal tariffs are likely to be announced, though a busy data docket is in the mix as well, including, of course, the latest US labour market data on Friday. Plenty for us to discuss on the trade-off this week, so without further ado, let's crack on with the show. So it was certainly a risk-averse week last week. The S&P down for a fifth week in six. And looking at where we trade this morning, or this afternoon, I should say, sentiment shaky once more as we get the new trading week underway. Someone who isn't shaky at all and knows exactly what's going on is my good friend, Ryan Littlestone from Forex Slow Live and Forex Analytics. So, Ryan, Liberation Day on Wednesday. You excited? You pumped? You ready to go?
Oh, yeah.
Jesus, make me sound cheerful there, mate. What's going on?
Is this an actual like a US holiday day? Is it a proper day, or is it just something Trump's made up? I don't know.
No, like most things, it's just some nonsense that Trump's made up. Although at least he was sharp enough not to make Liberation Day April the 1st, because that really would have just taken the biscuit, I think.
Yeah, exactly. I see you've got your April Fool's jacket on already, so you're well in advance of that.
Deary me. Well, I suppose the real April Fool's prank this week will come on Friday for me, when you find a way for me not to win your non-farm payroll sweepstake again, won't it?
I won't care, mate. I'll be on holiday.
Oh, yeah, all right for some, isn't it? You know, while all the rest of us slave away with our nose to the grindstone, and Ryan goes and puts his feet up on a sun lounger. Make sure you tie a hanky on your head, mate. Wouldn't want you to get sunburn on the bumps there.
You and working hard, God. If people check your social media to see when you're down the pub, I'll tell you what, you'll be in trouble, mate.
Right, moving swiftly on. Topical thunder, please. Deary me. Enough of our social lives. We do have business matters to discuss. And of course, the main matter on the minds of market participants across the globe is, of course, the issue of tariffs. And I think, to be completely honest with you, another week of nonsense on that front looks set to pan out. Firstly, it's worth bearing in mind that markets are still grappling with the fallout from the automobile tariffs that we had announced last week. A little bit of a surprise on that front, actually, coming on Wednesday, a 25% tariff on car imports into the United States. And this was much harsher than participants had expected on three fronts. One, because it was global and not just applying to Mexico and Canada. Two, because it was probably 5 to 10% more than most participants have been expecting. And three, because it even includes automobile parts, not just automobiles that are fully assembled. So when you think about how integrated the supply chain is, particularly in North America, this could mean that an actual car ends up being tariffed 3 or 4 times, as various parts, such as the engine and the gearbox of that car, fly between various plants in the United States and its neighboring countries. Anyway, as fallout from that continues, and we do see that posing a continued headwind, particularly in the European equity space as the new trading week gets underway, focus is beginning to fall on a couple of key dates that we have coming up this week. Now, the first is today, in fact, when you watch this video, Tuesday, the 1st of April. This is not an April Fool's joke. Let me just put that out there. And that is when all of the various federal agencies that have been studying how the US's trading partners operate are due to hand their reports back to the president. Now, this has been seemingly forgotten by quite a few market participants, but these reviews were launched on Inauguration Day, and they are now finally due to report back. And then, of course, that comes ahead of what's being dubbed Liberation Day on Wednesday the 2nd, when these reciprocal tariffs are likely to be announced and potentially imposed. as well as a whole host of other measures. These car tariffs go into effect, additional tariffs on China, et cetera, et cetera, et cetera. Now, I think on the issue of reciprocal tariffs, the big question for market participants is that we still don't know whether the Trump administration will account for VAT, value added tax, as a tariff. Now, let me just be completely honest. If they do, then it's economically nonsensical because people pay VAT whether something is made within the country or in a completely different country. But the big issue is if they do see VAT as a tariff, then it's very, very bad news indeed for us here in the UK and also our friends across the channel in Europe, because it means that the levy that is imposed is likely to be considerably higher than it otherwise would be. The second thing that I think market participants are perhaps a little bit complacent about is that it seems as if most are viewing Wednesday as a sort of one and done event. We get the reciprocal tariff announcement and then, everything's fine and dandy and we can carry on with our lives. But I think the real issue is that there are still a hell of a lot of unknowns around what comes next. We've obviously got countries that will look to make concessions and try and sort of wriggle out of the tariffs that have been imposed. We've got some countries like probably China and maybe Canada as well, who will double down and retaliate with their own tariffs. And then we've got Keir Starmer on Downing Street, who seems like he's just going to sit back and do absolutely nothing in response. But I think the nub of all of this is that as opposed to being the end of the matter on trade, I think this is really just the start of what could turn into quite an ugly tit-for-tat trade conflict across the globe. And to be completely honest, if that were to happen, it's a zero-sum game. Big downside growth risks and big upside inflation risks in the mix as well. And as a result of all of that, tariffs are not going away anytime soon. Trump's Truth Social account is not going away anytime soon either. I think as a result, uncertainty is going to remain elevated. Volatility should remain elevated as well. And putting all of that together, I am still pretty bearish on risk in the short term at the very least.
I'm surprised you're not heading to your bunker with all that uncertainty coming. Maybe stock up on spam and look yourself away for a couple of months.
I was going to say, I've stockpiled 6 months worth of spam at home, and I don't even like the stuff, as we saw that geezer come out with during COVID, if you remember that.
Yeah, I remember him. But you're absolutely right that this isn't, even when we get over this, it's not the end of it. I mean, he's already said he's going to, target pharmaceuticals next, and we haven't even got into agriculture. So we're not one and done. This will just be the next episode. We're either going to get a resolution, a can kick, or a complete mess. And then probably 2 days later, he's going to be on to the next one. So you can never take your eyes off these markets and what he's going to do. But there's one thing that has been happening, I think, over the last couple of weeks mainly, is when we started off on this tariff trail, shall we say, a lot of the market was looking at, well, how's that going to affect other countries? It's going to impact Mexico, it's going to impact Canada. And they were looking more at, hitting those currencies, for example. We saw Mex weakening massively, Canadian dollar weakening massively. But as time's gone on, it's more switched to, okay, Trump's going to do this, but he's going to impact his own country just as badly, perhaps. And with the data or the market getting a little bit sour over data, even though it's still not outright collapsing, I think there's a little bit of a shift between what's going on and what the market is going to trade on this. So far, we haven't seen as big a reaction in Canadian dollar and Mexican peso as we did in the other two deadlines. And I think that is because the market is more looking, well, if it's going to hurt them, it's going to hurt the US just as much, like you say, with autos. The amount of times parts cross over the borders back and forth. I was speaking to my brother-in-law about this. Parts can cross 3 or 4 times before they're actually finished and put into a vehicle. So how do you manage that for tariffs? I have no idea. But that's why I wanted to look at euro dollar for this one, because I think at the end of the day, whatever tariffs get put on Europe, whatever, you're going to see a negative reaction, obviously. But if the market comes to the conclusion that, as it's going to be bad for Europe, it's going to be bad for the US as well, I think the dollar side of things is going to outweigh the negativity you see in the others. So I can see the potential for the dollar getting sold off and all this tariff stuff more than other currencies weakening. And for something like euro dollar, which can't get away from this 108, 30, 70 big pivot zone, could see more upside here.
Yeah, and actually, I think that's a really interesting point. And this is something I was talking about last week with a few clients and some journalists is, it's interesting that the dollar hasn't traded like a safe haven recently. And actually, if you think about it, what are participants trying to do? Well, they're trying to get away from all of the tariff nonsense. They're trying to shelter from that trade storm that is brewing. So why would you go and buy the dollar? Because that's, of everything, the asset that is most exposed to all of that uncertainty and all of the potential economic downside that could be caused from those tariffs, because ultimately it is the US consumer that is going to be paying these tariffs, and that is ultimately how a trade war works. And let me just stress that my bullish euro dollar view that I also hold has absolutely nothing to do with the fact that I have a rather expensive lunch riding on us touching 110 at some point in the near future.
No, I remember we put that on quite some time ago, probably before we really got stuck into this tariff stuff. So it is long running, and you might get that resolved sometime in the next 5 years, I think.
Well, fingers crossed. Anyway, moving on. You wanted to talk about my least favourite subject at the moment.
Your least favourite subject, one of my most favourite subjects, and that's sentiment, and that you really can't ignore it at your peril. Sentiment's very important for trading. It's important for my trading, whether that's sentiment surveys, market sentiment. It can have a very powerful impact on moving markets. And you only have to look at the market, how it's turned bearish over the US with all this tariff uncertainty, how it's affected business surveys, reports like the ISM, and how consumer surveys have started trending down. This is all without the actual hard data actually really making it look like things are getting really bad. Now, I've had plenty of discussions about sentiment data on the socials with you as well, things like the Michigan survey and whether it's worth the paper it's written on. But I've been following sentiment surveys pretty much all my entire trading life. So I know how watching even the smallest of sentiment surveys can lead to catching early trends and market moves. Now, right now, it's a fact. Inflation is still proving sticky. There's been no surprise given that the S&P PMIs have been reporting higher prices for months. The ISM PMIs have been reporting higher prices for months. The Michigan survey expectations have been jumping for months. We've had the conference board inflation expectations jumping as well. The Eurozone economic sentiment data, consumer price expectations and firm selling price expectations rising for months. We've had the UK CityGov poll on inflation rising again, highest in 14 months. We've had CPI data today. We had France and Spain last week, a little bit softer. We've had Germany and Italy today. Italy higher, Germany coming in a little bit mixed but sticky overall. And so all this sentiment data, even just on inflation, what are central banks saying? It's transitory. They're ignoring it, brushing it under the carpet. It's temporary. Well, we know how that turned out a couple of years ago, don't we? So my trading antennae is well and truly up for signs they're wrong again. And if they are, there's going to be some big moves coming once again. But it's not a done thing that sentiment surveys lead to hard data changes, but I've seen it enough times when that does happen.
Right, well, now Uncle Albert has finished his little rant there. I mean, what do you want, a rate hike?
Well, I don't know. I might call Dickie for one. He'll be up for that.
Well, yeah, speaking of Uncle Albert, there you go. Yeah, I just really struggle to buy this one, to be completely honest with you. I mean, everyone's got very excitable about inflation and also the idea of stagflation. Frankly, I think it's got to a point where the data needs to back this up. You look at the recent figures that we've had out of the United States. GDP growth is okay. Retail sales are fine. What are people getting worried about? Well, most recently, participants seem to be worrying about the core PCE figure on Friday, which came in at 2.8%. Yeah, it was hot, but if you listen to what Chair Powell was saying at the press conference 10 days ago, he said core PCE will be 2.8%. And then it comes out at 2.8%, and people are surprised and acting as if the United States economy is suddenly going to blow up. I mean, pay attention. Come on. Then we move on to the UMIC number. We've got people thinking that the US is becoming an absolute basket case because of a politically skewed survey where they bring up 500 people and ask for their opinion on how the economy's going. If you dig into the data, Democrats think that the US is going to descend into being basically akin to Zimbabwe by the end of the year with no growth and high inflation. Republicans reckon it's some sort of economic nirvana with independent voters somewhere in the middle. I mean, come on, it feels like everyone's running away with themselves. And I'm going to talk about the jobs report in a second, but if that's poor, then obviously people are going to go even further with these recession worries. But I think really it all feels a bit overblown, to be honest. We've got a couple of surveys that I would say probably aren't worth the paper that they're written on, and we've just had a massive overreaction to it. And I'd say the same thing about all the other inflation expectation surveys. I mean, I would challenge any of our viewers, go and plot on your chosen trading terminal of choice CPI for the country in question against consumer inflation expectations for the country in question. There's almost no correlation between the two. If I go and ask a bloke out in the street now how much he reckons a pint's going to cost next year, I bet you he gets the answer wrong. And I think markets are probably focused on the wrong story with all of this.
I don't know if you know how much a pint is, mate. The amount of times you go to the bar, by all accounts, or what I hear from other sources. But the
worrying thing is I know exactly what you're getting at with that one.
No, that's it. That's all I'm going to say on that subject. But you've got to look at the other side of the coin to all this. It doesn't really matter whether you believe the surveys or not. It doesn't matter. Look at the reaction we got in markets on Friday after that Michigan survey. We saw stocks hitting the lowest in a week, actually breaking down after that. We're getting moves out of this, and I'm a trader. I want moves. So I've got my fundamental side and I've got my trading side. Okay, I know this data can move markets. The proofs have been in the pudding. I also know that I need to see the hard data turning the same way as the sentiment data. If it doesn't happen, fine. I don't really care. I'm not here to be right or wrong on that sense. That's only right or wrong in how I trade it. That's what's more important. So this stuff is moving markets. We need to pay attention to it. And if it does continue going, though, I will guarantee you we will start seeing the hard data turning.
Guarantee.
Guaranteed.
Punchy language from
there we go.
Littleston down on the seaside there. Speaking of hard data, let's move on, because we could argue about that all day, but we'll save that for the pub, because we do, of course, have the March US labour market report to deal with this week. Now, I'm sure Ryan has, as we mentioned earlier, 4 days now to work out how he's going to rig his sweepstake out of my favour. But nevertheless, in terms of market expectations, and you'll get my guess later in the week, as usual, headline non-farm payrolls are expected to have risen by 140,000 on the month. That would be a modest slowdown from the 151 that we saw in February, but it would also be considerably above the break-even rate, which is between 80 and 100k at this moment in time. Earnings, they're expected to remain unchanged at 0.3% on the month and at 4% on the year, while unemployment, that is seen unchanged at 4.1%. After that surprising rise last time out, with participation also unchanged at 62.4%. One thing to bear in mind, and forgive me for getting a bit nerdy here, unemployment in February was actually 4.1395%. The reason I note that is because it's not actually out of the question that just rounds up to 4.2%, even if it's a low 4.2% because of that rounding. It could be something that makes a few people a little bit jittery, given those slowdown fears we were just talking about. There's a lot of unknowns around the figures, to be completely honest with you. Leading indicators are, well, the ISM PMIs aren't out yet, and jobless claims, both initial and continuing, were pretty much unchanged between the two survey weeks. But we've, of course, got to consider the impacts of the DOGE, Department of Government Efficiency, cuts to the federal workforce, the ongoing federal hiring freeze, also the potential spillover effects of that federal hiring freeze on people like contractors, and the broader economic uncertainty, which could pose a few headwinds as well. I think there's a couple of ways to look at the jobs report. For a policy perspective, I think it's very, very tough to imagine this being any sort of game changer. The Fed are firmly on the sidelines for the time being, and also most FOMC policymakers are focused primarily on the inflation side of the dual mandate for the time being as well. So I don't think this is suddenly going to force the Fed to act, particularly when there is not really a Fed put at this moment in time. But I think in terms of financial markets, I would say that there are, to coin a rather economicsy term, asymmetric risks around the jobs report when it drops on Friday afternoon. And what I mean by that is that if we see a dismal report or any sort of downside surprises, then naturally that's going to send slowdown and recession fears through the roof, stocks lower, treasuries will rip higher in terms of price, yield lower across the curve, and likely the dollar softer as well. But on the other hand, if we were to get a solid report, then I don't think that would be enough to completely soothe all of the worries that we see in terms of economic growth. And I think most participants would probably go, it's a bit of a slowdown being postponed rather than a slowdown being completely off the cards, particularly with all the various downside growth risks that we have coming from trade as well. So, yeah, I guess as I've said at the bottom there, it's the most important jobs report that we've ever had until the April jobs report, which will also be the most important jobs report that we've ever had.
Yeah, interesting. You're talking about market sentiment there, Michael, and the reaction on that after not being a sentiment fan, but I digress. But I think you're spot on. The reaction is going to be pretty simple. Anything on and around the numbers, we get a move for about 30 seconds and then on we go, and it's in the rearview mirror pretty quickly. And yeah, exactly as that. The market is waiting for a bad one. If it gets its bad one, then it's going to react to the bad one. And then, like you say, recession fears and all the rest of it. So I think when you look at the numbers, you've got to keep an eye on those government payrolls in case we get a wobbly headline, and it's all down to those government jobs, because we know it's coming. We don't know when. We don't know how it's going to be split out. You know, some of these federal workers still being payrolled, the voluntary ones, I think, still being payrolled till September. So they won't potentially show up in the numbers until then. I think we've got Challenger layoffs this week as well. We should do anyway. So that's a number to keep an eye on, because that has been running pretty hot. And that just shows you companies who have announced their willingness or they're going to make layoffs, even though they're not 100% confirmed. That is something you need to keep an eye on, because that's a piece of data that could indicate that things are heating up in the layoffs market. But as for the rest of it, I think you've got to look at something like 10-year bonds for this one. And purely from the point of view of deciding whether this data is going to be recessionary or not. I mean, we've had some pretty wild moves. I mean, last week we were looking like we were breaking up towards 440, 450. And then again on Friday, that Michigan data, and we've seen a complete reversal in yields. And now yields are coming down because the market's getting antsy over the US economy. So they're locking in yield, a bit of, out of equities into more safe treasuries. So I think this one is going to be key. If it's good data and you see yields rallying, like Michael says, it's probably not something that's going to last. And that might be a bit of a fade opportunity for there and in the dollar.
Yes, indeed. The other thing I would just mention, you spoke about federal layoffs. One thing that we probably haven't discussed as much as we should have done, and we've got lucky because it hasn't happened yet, is how Thursday lunchtime every week is now a risk. And what I'm alluding to with that is the jobless claims report out of the United States, because at some point we are going to get an initial jobless claims number that is not 220-ish thousand, and it's 260, 270, 300, 350, whatever it may be. And the market suddenly has a real panic over the state of the US labour market. And it's a question of when that arrives rather than if that arrives, particularly with all these things like federal layoffs going on, various other, just the general sort of uncertainty on the trade front, whether we start to see layoffs as a result of the tariffs that come in after the 2nd of April. And I think that's something that it's not necessarily impossible to hedge for, but it's very, very difficult to hedge for, particularly when we're now, 70, 80 days into the Trump administration, probably 6 weeks into this government efficiency drive, and it hasn't happened yet. We're sort of at that perfect point where participants are potentially becoming complacent that it doesn't happen, and then all of a sudden we do get a grim jobless claims number. So that's the other thing to watch in terms of the US labour market. Obviously, a weekly series is very, very volatile and choppy in nature. But again, at a time where participants are worried about the US economy slowing, the last thing that the market needs, at least if anyone's looking to buy the dip in risk, is a jobless claims print that suddenly goes through the roof.
Yeah, well, I hope you get that Thursday, mate, when I'm on a plane heading to sunnier climes.
Yeah, I bet you do, mate. Right, I think we're going to discuss geopolitics lastly for this little segment.
Yeah, unfortunately so. We're back at that old subject again. And as I've mentioned before, it's always hard to talk about market implications for any sort of conflict, because obviously lives matter more than pips. We all hope there's a speedy resolution and that brings peace to the region, and we can move on. So even so, we've got to pay attention to what's going on there because it is market moving. Now, I was perhaps a bit too hopeful for my sins that Truss could resolve this situation quickly, but despite getting this watered down peace ceasefire, the bombs are still running, flying, the bullets are still flying, and both sides still can't trust each other as far as they can throw each other. So the situation, I think, is really coming to a bit of a knife edge, because if Trump and the rest can't get a full ceasefire and steps towards ending this conflict altogether, I think there's a massive risk that it could escalate further and things get really decidedly darker. The risk really ramps up if the West would be forced to take stronger action. Additional sanctions just won't cut it, I don't think. If there's no peace in the Ukraine, no deal, then I think, there's a big risk that it falls entirely to Russia. And then that something will put the situation on a military footing between the US, Europe and Russia. And that's a big step that the market won't like, obviously. Now, over the weekend, we heard from Trump saying he's cheesed off, to put it politely, with Putin, and might start responding with increased tariffs on Russian oil and any country who deals with them. That's a ramp up of rhetoric, but it's still kept a sort of trade tariffs for now. So let's hope that we're still very much in a negotiating phase, and this chest beating is just that, before all sides finally find a solution. Otherwise, I do fear for what the alternative may be in the weeks and months ahead.
Yes. Well, I mean, firstly, let me echo your sentiments. Of course, I think we all hope that some sort of sustainable peace is achieved in very, very short order, and that nobody ultimately is losing their life. I mean, unfortunately, we do need to think about the macro and the market implications of this as well. And I think it is becoming interesting how, as you said, much more politely than I was going to, about Trump's sort of anger towards Putin over the weekend. And again, the threat of tariffs being used to try and bring people to the negotiating table, as we've seen done so many times in the past. It does feel as if progress on this front has sort of stalled out over the last couple of weeks. And also we've had, I think, twice now where a ceasefire has sort of purportedly been agreed, or, there's been an agreement not to strike various types of infrastructure. And then within a day or so, well, we're sort of back to square one. So it does very much feel like an issue of sort of two steps forward, one step back, one step forward, two steps back going on in terms of actually getting to the end of the conflict here. And I think it's not necessarily something that's weighing on markets, but I think it's also something that, particularly for European assets and something like the euro, where we've seen, the euro just kind of meandering around this 108, 109 region for the last couple of weeks now. You'd almost say, actually, if some sort of truce were to be agreed, maybe that's the sort of shove that the euro needs just to move a little bit higher and potentially towards that 110 mark, because markets can price out a chunk of geopolitical risk premium that naturally at the moment is still in the price. But I think from a sort of broader perspective, I think we've probably moved away from an outcome or a scenario where, if you said this time last year we get a peace deal in Ukraine, where does the market go? Well, risk goes through the roof. I'm not sure we're quite at that stage now, given what's going on the trade front.
Yeah, absolutely. Well, the trade front has just become another thing we have to deal with on top of everything. But I still think there's scope for, say, a good risk rally if we do get a real idea of peace happening over there. But I just think we've moved into a different stage now, and there's got to be a resolution one way or another. Either the Trump and the West go, right, we've tried, that's it, that's the end of it. What do we do now? Do we put up a military wall? Do we get tough and escalate things? Or, hopefully we go the other way and we get a negotiation. But something is coming. As I say, we're on a bit of a knife edge, I think, and we're going to fall one way or another.
Definitely watch this space, I think, and keep our fingers crossed. In any case, let's move on to our plays of the day. So we're both in the FX space this week. I'm looking at the dollar first of all. The greenback, as well as I just alluded to, really, having kind of trod water around the 104 mark into month end, and we continue to trade as near as makes no difference at that level this morning. And my play this week is to be wagering that we see downside in the dollar resuming, or I could even say continuing, given the broad downtrend that we've been in since Inauguration Day in January. As we were speaking about earlier, the dollar really right now is not a haven whatsoever because of all G10 currencies and actually all currencies. Full stop. It is the most exposed to the uncertainty and the incoherence coming out of the Oval Office. And of course, that uncertainty in turn has really kind of killed dead the idea of US economic exceptionalism. I think it's pretty tough to envisage a sustained bull case for the greenback here unless we see President Trump change tack and begin to make more concrete decisions in a more coherent way, which frankly, feels like a bit of a long shot. In terms of levels to watch to the downside, well, firstly, it's notable this recent rebound hasn't managed to take us north of the 200-day moving average. But at the downside, I think the most obvious level to watch is the year-to-date low, which is around 103.25. If we break below that, then we could see a more sustained run lower. And I think it's also worth just bearing in mind. And of course, the Treasury Secretary, Scott Bessent, he effectively has 3 trades for the entirety of the administration: lower 10-year yields, lower crude prices, and a weaker dollar. And at the moment, the Treasury Secretary is getting his way, and I would argue not necessarily for the right reasons, although I'm sure we can discuss that in another show, because Ryan wants to talk about the peso.
Yeah, this is a short trade I played on the last tariff deadline drama, and I'll mine it up again. Well, actually, I'm still in the trade from that last one. I'm still short from 2098, but I've got a trailing stop just above 2060. So that might have to go before I then to look to retry this one. I'm not blinkered to the fact that the trade is different, even when the underlying dynamics may be similar. I have a stronger feeling that we may not get the same outcome or better than we did the last 2 deadlines, which will keep me on the cautious side. And I won't be going heavy on my trade size, at least until I know the details and feel maybe comfortable scaling up the trade a bit. So what I'm going to do is potentially look to lean against the 2080, 21 levels that we've seen previously for shorts again. I won't trade them blindly though. I'm looking to catch a positive reaction more than just an actual price level, but those are the sort of areas I'm looking at, as I say, rinse repeat of what I did last time. So short dollar mix for me.
Good stuff. Thank you, Ryan. Well, that does indeed bring us to the end of another show. Thank you very much, as always, to my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics for bringing this together, for joining me, and also to our producer Kyriakos for bringing this together as brilliantly as always. If I can get that the right way round, I'm just going to wrap this up. It's descending into shambles here. Hopefully, you've enjoyed the show. If you have, do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets and your thoughts on everything that's going on. And we'll be back in 2 weeks' time with another episode of The Trade-Off. As you may have figured, Ryan is going off to sit on a beach somewhere, leaving me to man the fort here at Pepperstone Towers. And God only knows what he's going to come back to, given the way the economy and markets are working at the moment. In any case, in a fortnight's time, we will be back, and we will see you then. In the meantime, thanks for watching, and goodbye for now.